I got a good one for you guys today. This is a sleeping giant that is beginning to rear its ugly head, and it could disrupt the economy and the markets as a whole. Now, let's imagine that a central bank decides that the economy needs help. We've seen that before. So it decides to print money out of thin air, not by printing trucks full of cash, by literally just typing numbers into a computer on a ledger. That money then enters the financial system through good old banks. Now, investors suddenly have more liquidity and access to capital, and that money starts to look for a home and somewhere to go. Some maybe flows into stocks, some maybe flows into real estate, some is going to flow into crypto, private equity, the list goes on. Asset prices now start to rise as a result. Homes get more expensive, stocks hit new all-time highs, but here's the thing that nobody tells you. No new houses were built overnight. No companies suddenly became more profitable overnight. No new productivity magically appeared. What changed wasn't the assets, it was the amount of money chasing them. Liquidity moves first and price follows. And right now, liquidity is doing something very different, and almost nobody is paying attention. Let's dive into it in today's episode. Whoa. Welcome back. As always, your host, Matty A. If you're new here, this show was built for real estate investors and wealth builders who want the financial intelligence the mainstream won't give you. I try and cut through the fluff. I try and talk about the real shit that is going on, that is impacting your wealth building journey, and most importantly, the wealth that you've built thus far. This is to give you the alpha, the edge, and really, these are stories that are important to me, that I find very interesting, that help impact me on the strategy and the decision-making I make on my own financial journey. So take it for what it is, apply it if you want, leave it if you don't, but I appreciate you being here. So today's episode is one that I've been wanting to do for a few weeks now, and honestly, I think it's one of the most interesting topics that is floating out there right now that many people just aren't paying attention to. So we're going to cover two things: how money actually moves through the markets, and then zoom in on a specific corner of the financial system that I believe is starting to show some serious cracks right now in 2026. Now, we could go down probably a lot of different veins that may have some cracks or some data or some ideology that supports there being some concerns in the economy. But this one in particular, I think, is starting to move a lot faster and can't be ignored. So, quick lesson. And I want you to stick with me here because this really sets everything up to give a little background, a little context. When a central bank injects money into the economy, here's what most people picture, right? Some government official handing money to regular people who go spend it at a grocery store, at a restaurant, and that's just not what happens. The money enters through banks and financial markets first. It really doesn't get to the people that really need it. It goes to, of course, the people, the organizations, the institutions that are at the top of the totem pole first. And specifically, it goes to banks. Banks suddenly have more reserves that they have access to. And institutional investors suddenly have more liquidity. Now, we've seen this throughout the course of the financial markets and history of our country. And all of that money needs to find a home. It can't just sit there, right? It's going to be stale capital. We got to put it to work. So what does it do? It starts flowing out of the banks. And the first place it goes isn't to individuals' wages or their pocketbooks. It isn't to Main Street. It generally goes to Wall Street and or into assets, stocks, housing, land, private equity, venture capital, right? You name it. And this is why real estate values went absolutely crazy after the 2020 pandemic. The Fed flooded the system. That money had to go somewhere. And guess where it went? It went straight into asset prices. And this is what we saw. A lot of capital going after the same, if not less supply, which we know, simple supply and demand economics, we saw prices go vertical. And you felt it if you owned a property. I know there were a lot of people who benefited from that. You felt it if you were trying to buy a property as well, the competition and the challenges of getting into an asset. Now, here's the flip side, and this is crucial. When liquidity drains from the system, right? We know what happened when it flooded the system and it got very expansive, but what about when things got retractive and condensed and drained from the system? The reverse happened. Asset prices began to compress, credit tightened, deals froze, we saw less transactions happening, and the investors who over-leveraged during the easy money era started feeling some real pain. And that's the world we're in right now. But there's a specific market where this tightening is happening extremely fast and is trailing what most consumers felt and saw in the post, call it 2022 era of COVID. And most people aren't paying attention to this right now. The market is what we call private credit, private debt. This was a space that absolutely exploded after COVID in 2020, all the way up into the current day today. So what is private credit? Real quick definition. Private credit is loans made by non-bank lenders, investment funds, right? These are not your FDIC insured banks. These are, I can create a private fund. I'm in the process of finalizing a private debt fund where I can give loans on houses, on flips, on commercial properties to businesses if I want to. That is private credit. You come to me, I've got capital, I've got a fund structure, I have the ability to give you debt. Now, many people talk about this as like shadow banking, right? It's the little brother to the big brothers of the banking world. Wall Street funds lending directly to mid-market companies, tech startups, software firms. No public markets are involved in this process, right? And really, as a result of that, there's much less regulation. And as a result of that, there's much less transparency into that world. So over the last decade, this market has really exploded. It's now sitting at roughly $1.7 to $1.8 trillion. So for context, the subprime mortgage market that caused the 2008 financial crisis, that was smaller than this. So as you can see in relation to that, and we all know what happened in the 2008 financial crisis and the ripple effect that had throughout the economy, this bubble is, in my opinion, much bigger. Now, here's what happened in just 6 weeks at the start of this year in 2026. I'm going to walk you through this like a chain reaction because that's exactly what's kind of happening right now. Dominoes are falling and it could lead to something much bigger. So step one, domino number one, JP Morgan marked down its private credit loans and restricted lending to private credit funds. One of the biggest banks in the world just said out loud, finally, we don't like what we're seeing in this market. We have some concerns. We're going to pump the brakes. Okay. So step two, Morgan Stanley blocked redemptions at its private credit fund called North Haven after withdrawals surged roughly 11%. Basically, investors went back that invested a bunch of money in their private credit fund. We will give you this money, go put it to work, and we want to clip our coupon. You pay us, and we'll allow you to have our money. Well, as we start to see things tighten up, we see the economy, have some challenges. We see fear, uncertainty, doubt maybe start to increase. What do people want? They want to get their money back and, replenish some of the coffers, have a little dry powder, have some sleep well at night money available to them. And these investors went to these private credit funds and said, we'd like, our money back. And Morgan Stanley said, nope, not so fast. Step number two. Domino number three, Cliffwater. This is a $33 billion private credit fund. They also then got hit with 14% redemption requests. And they chose to cap payouts at 7%. Investors wanted out. The fund couldn't keep up. So they capped it and said, hey, this is all we can do. Sorry, you're locked in. Now, domino number four, a company called Partners Group, one of the largest private equity firms in the entire world. Their chair came out and said defaults could double from where we are at right now, basically kind of setting the precedent and the table that this could get a lot worse. Step number 5, domino 5, is Fitch, which is the credit ratings agency that we all kind of know about. They reported U.S. private credit default rates are going to hit north of 10% here very, very soon and are currently at 9.2%. This is the highest ever recorded in the private credit market. And it kept going. Then last week, we saw Blue Owl, which is a $273 billion fund. They halted their redemptions completely. Blackstone raised its withdrawal cap and injected $400 million of its own money just to cover some of that demand. Now, obviously, they've got a big balance sheet. They can do that. But at the end of the day, right, they're pulling from one side of their coffers to backfill and support another side just to keep up with some of that redemption after they called a cap on it as well. So BlackRock limited withdrawals on its $26 billion private credit fund, and UBS called for, and I'm quoting here, cascading defaults and widespread contagion. Now, we all know what happens when people get fearful, right? And the idea of contagion, it can lead to a very major domino effect. So, and this is not amongst retail people going to the bank and be like, I want my $5,000 out of the bank. No, we're talking 7, 8, 9, 10-figure investors going to big private credit funds and saying, we don't like what we're seeing here. I think we want to take control back of our money, and them saying, we can't do that right now. So these private credit funds borrowed money from banks to lend to companies. Banks are now cutting them off, and those funds can't refinance their capital. So we're seeing redemptions begin to accelerate. They're being forced to sell assets at a loss. And the companies that borrowed from the private credit funds, whether it's the tech startups, the software firms, the mid-market businesses, right, the private debt funds, they can't refinance either. So defaults can not only are cascading, but can cascade at a much higher level at a much more rapid pace if this continues on. And we're not talking about 9.2% being the ceiling. Analysts are modeling 15 to 20% by Q3 of this year if these same types of conditions continue. Now, there's a lot of stuff going on globally, domestically, geopolitically, you name it. And obviously, these are all variables that tie into the narrative and the facts and the data, right? So this is something that could become a much larger problem if we stay on the path that we're on right now. Now, one quick credibility note, because I want to be straight and share my thoughts on all of this. All of these data points are verified through Bloomberg, Reuters, Financial Times, and Fitch, all from March 2026 reports. So take that for what it is. But at the end of the day, this also isn't just speculation, right? This is coming out of these organizations themselves, and these things have actually happened. So this is the real question. Is this going to be a 2008 style replay or meltdown? Now, my answer is no. The full cascade scenario is probably a 20 to a 30% probability right now based on a lot of the data and the things that I'm seeing. Losses are contained to certain asset classes. They're isolated. They're, somewhat being insulated, and moats are being built around them to ensure that, hey, let's remove this domino so it doesn't knock everything else over, right? But what we do know is obviously banks are buffered. We haven't seen any broad contagion yet, but I would say that the stress is real and it is elevated right now, and it is something that we should be paying attention to. And the Q2 data is really going to be what we want to keep our eyes on. So the reason I'm covering this now is because of what's happening at the same time. This is the wild card that ultimately is tying into a lot of this. This is kind of an underlying catalyst that, I think is playing and influencing and impacting some of this stuff. We all know that fear, uncertainty, and doubt, oftentimes created in times of war, create, additional fear, and people do, wild things and get emotional when fear is high. Right now, we have major issues around the Strait of Hormuz. 21% of global oil supply passes through that waterway specifically. Now, right now, ships are getting hit. Ships are being halted. Fires are being reported. There's a lot of fear. Who knows what is real, not real? What's AI? What's not AI? We got Iran talking about laying mines. The U.S. has struck mine layers. It's all kinds of fucked up. Now, that being said, why that matters is because of energy prices. But here's why it matters beyond just energy prices. Oil shock equals inflation expectations going up. And if we really do see rising energy prices and inflation go up, then that means the Fed can't do what? They cannot cut rates. And we know that Trump wants Mr. Too Late Jerome Powell to be cutting rates yesterday. But the longer we stay in Iran, the longer that this energy concern, inflation concern becomes real, elevated, the more that goes on, the harder it becomes to get them to cut rates. And if rates stay elevated, right, we know what happens there. We definitely are going to see things become more economically challenging to make deals pencil. Companies, it's going to be harder for them to service their debt, which feeds right back into what? Private credit default problem that we just walked through. So this is the part historically that doesn't end well. Inflation going up while jobs are going down, that is stagflation, which is the worst possible backdrop for a credit crisis. And in 2008, there was one crisis. It was just a housing collapse. Well, right now in 2026, you have three running simultaneously: a private credit, at least looming potential private credit implosion, a war-threatening global energy supply, and a bond market that can't easily absorb that shock. So I don't believe anybody is pricing that in, at least not yet, not right now, but they could be very soon, which could be a potential catalyst for some major pullbacks in certain asset classes throughout our economy. So what does this mean for you? Okay, well, I'll just stick and speak to my asset class, real estate. Now, whether you're a real estate investor, a wealth builder, stock investor, right? Let's just wrap this up and bring this home, because this is more just to bring awareness and attention, because I'm finding it interesting and I'm paying attention on how this could potentially impact in a positive or a negative way what happens in the future. Now, first, private credit funds lend to commercial real estate operators, developers, bridge loan borrowers. And if those funds freeze or they go away or they retract in a really big way, right, refinancing windows are going to close. And if you have a bridge loan maturing in the next 12 to 18 months, you need to be paying very close attention to who your lender is and what their capital position looks like, because at the end of the day, if it impacts them, it's going to impact you. Now, second, cap rates are under pressure right now. If credit continues to tighten and rates stay elevated, we all know what happened when rates started going up in 2020, late 22, 23, 24, all the way up into where we're at right now, right? Is valuations are going to compress. Margins are going to compress. The math on deals that penciled in 2021 and 2022 isn't going to pencil the same way today. So that is going to be another impact. Now, third, and this is the opportunity framing, distressed assets, right? We're going to see distressed assets, distressed prices, motivated sellers, and equity plays are going to emerge out of this when credit dries up. And the investors who have dry powder and a clean balance sheet and have their financial house in order, those are going to be the ones that are going to make a killing. Those are going to be the ones that have their pick in this environment. So I'm not ringing the alarms saying that we're heading for a 2008 replay. However, there are some things that we don't want to be, let's just call it, negligent about paying attention to. Or as Patrick Bet David always says, is like a healthy level of paranoia, I think is important as an investor, right? Is to not always be convicted in one way or path forward and it being great and simple and rosy. Like, we got to look at the threats. And this is one that you just got to look at. Now, think about 2009 and 2010. The people who had the cash and the conviction when everyone else was frozen, they made generational wealth. And we also know that that window doesn't stay open for very long. So the liquidity lesson here applies directly. Liquidity flooded in from 2020 to 2022. Prices skyrocketed. Liquidity drained from 2022 to 2024. Deals froze. Values softened. We saw markets go really stagnant, really hard to get deals done, right? Now we may be entering another liquidity shock, but this time it's coming through the credit channel, not just through rate hikes and what the Fed is doing. So a different mechanism, same impact on asset prices, but a different mechanism. So here's my takeaway for you, and I want to say this clearly. The investors who win in the next 18 months are not the ones who are going to panic. And they're not the ones who are also going to ignore this either. They're the ones who understand the mechanics. They stay liquid, they build the right banking relationships, and they're positioned to move when the distressed opportunities show up. They're also the ones who are willing to get creative on how they structure deals and opportunities to create a win-win. That's the beauty of this world that we play in, is you can get as creative as the minds at the table are willing to get. And when distress, fear, uncertainty, doubt are at an all-time high, creativity is somewhat endless. So a few things to watch: Q2 private credit default data, redemption spread. Are more funds gating withdrawals? Are we seeing oil prices go up? Are they going down? Are we pulling out of Iran? Was this a war that is going to continue on? Is this just an operation? What's the new Fed chair going to do? What's his sentiment, his language, hawkish, dovish, right? These are all things that we want to be paying attention to, and also knowing that commercial real estate has a lot of maturities coming up. So definitely be paying attention to these things. The quiet forces in markets always move before the headlines catch up. So make sure you're listening and paying attention. Liquidity moved first in 2020. Prices followed, liquidity tightening up again now, right? This is your early warning signal. So that's today's episode. If this was valuable, share it with another investor in your network who might find it interesting. I'm curious on your guys' thoughts. If you want to go any deeper on this, don't forget to reach out. Shoot me a message, 844-447-1555. As always, appreciate you tuning in. Keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers. Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionofmindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at @officialmattia, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Million of Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.